So the next group, the ratios under the next group, that is capitalization, leverage or solvency ratios, we discuss on debt equity ratio. If there is a variance in this ratio, if the ratio is high, what interpretation we can make, or the banker would make, or if it is low, what would be the interpretation? So if the debt equity ratio, that is debt to that of the equity, that is the ratio. The formula is also total outside liabilities to net worth of the unit. With that ratio, if we are getting a high ratio, in the sense if it is beyond the benchmark level, benchmark level is 1:1 so far as large industries are concerned, then 2:1 so for medium this one, 3:1 all other units other than SME. SME relaxation is that up to 4:1. If it is going beyond that, if very high itself is not a good symptom, a good sign or symptom. If the debt equity ratio is high, it shows that the contribution, equity, the contribution of the promoter or the unit is low, because debt is more, disproportionate. That is the reason why the ratio is high. Then if it is, and another interpretation is over trading. This unit must be doing in addition to or instead of main activity, it may be doing some other activity also. That is the reason why the debts may be much more higher than what is in the normal situation. So these are the two interpretations, two inferences can be inferences the banker would look into when this kind of ratio is on the higher side. On other way, if the ratio is lower, then it shows that it is unable to get the credit. The credit because of some problems, the unit is not able to get credit for its purchases. So in that case, what is the situation? The creditors level will go up. Naturally, the ratio will be unable to get the credit. In the sense, its ratio will creditors level will go up. With the debt equity ratio, it is unable to get the credit because the unit is not in a position to get the credit. So the unit has to resort to cash purchases. So naturally the creditors level would be low. So the outside debt would be low, so the ratio will also be low. That is a good sign. If the ratio is on the lower side, that indicates that it is a good sign. Whereas due to some problem, the unit is not in a position to get the credit than expected. Then another indication is that high capital gearing. High capital gearing means the equity, the contribution of the unit is much more than the required level. That is the reason why equity is more, and the debts are by and large the required level or the normal level. So in that case, since the equity being high, the ratio would remain lower. It is also a good sign. That means promoters' contribution in the business is much more higher than the required level. Then conservative management. Yes, they are very conservative. They don't want to depend on outside party. They don't want to go in for outside debt. So try to, or they may go for the minimum debt, the minimum outside debt. And in that case also, their equity, since their equity is strong, the ratio will tend to remain low. All these interpretation, this position, that's a lower debt equity ratio, it's a good sign so far as a unit is concerned. Then the same is in the case of funded debt also. If it is high, the same. That is a low stake and over trading also, it can indicate over trading also. And here also, if it is low is good. Unable to get credit, high capital gearing, or conservative management. Same interpretation can be drawn if the funded debt equity or the debt equity is high or low, because this is mainly used when the term loans are involved. Then the third group, because classification we have done in 4 sections, 4 groups. There is the first, that is the liquidity we discussed, then capitalization or solvency or leverage we have discussed. Third one is activity ratio. Here we said we have talked on various ratios, that inventory turnover ratio, debtors velocity ratio, creditors velocity ratio. If this inventory turnover ratio is on the high side, is higher, what is the interpretation we can make? One negative feature is a sort of brisk trading, that is trading which is beyond the capacity. Then another one is, suppose this also can be inferred that the manufacturing unit must have gone for trading activity. That is the reason why in the trading activity stocks may not be there, it will come and go and holding will be less, so the turnover would be more. So it will give and a turnover would be the trading activity, in the sense the turnover would be more. So that is a good sign, but here is diverted his activity to trading activity also. Else this high turnover ratio is good. Then another, if it is low, that another negative feature is that obsolete stock holding is less. That is the reason why, because it is more, obsolete stock is also there. That is the reason why this ratio is showing a ratio is lower. Then sometimes it is a marketing problem also. All these things are required to be, because why this analysis is being done, why the interpretation is being drawn, is to just to understand, and based on that the banker can explore, banker can take a suitable credit decision. The another ratio we are going to, the debtors velocity ratio. The debtors velocity ratio, that is, if it is more, that is, if it is more in the sense unable to insist on payment is held up. That is one symptom. Second one, highly competitive. That is the reason why he is not in a position to realize the debts, realize the receivables. Then poor quality of the goods supplied, but money is not coming because of the quality problem. So he cannot insist also, the unit cannot insist also for early payment. So the ratio will remain high. In the other way, if the ratio is low, that indicates it is a weak management. They are not in a position to realize the receivables. That is a poor receivable management. Then cautious trading. Sometimes it may be very cautious. They don't want to sell on credit. In that case, a receivable would be less, and naturally, receivable would be less, and in turn, the ratio will also be low. Then only net sales are taken, entire sales might not have taken. These are the probability or interpretations which are being drawn when this ratio is high or low. Then creditors, the same time. Creditors means if it is high, creditors level ratio means unable to pay the creditors, because creditors are more, unable to pay the creditors. That is also not a good sign so far as a banker is concerned. Then quality of the goods received is poor, because if the goods received is not up to the mark, then naturally the payments will be held up. So that is also, that may be one of the reasons for this higher ratio. Then if the ratio is on the lower side, is low, what is the position? That it can be poor management reputation. That is one. Then product is a great demand. So whatever they produce, it can be sold, and hence it is in good demand. So the ratio will be on the lower side. Then the fourth group, that is profitability ratio. One of the ratios, the return on investment. If the ratio is high, what is the position? We can interpret that the efficient utilization of assets. because that high ratio that indicates means its investment, what is the proper utilization, adequate efficient utilization, thereby is profitability. Profits are more, in turn when the profits are more, the return on the investment would also be higher. That is why if it is high, that is a good sign, that indicates that efficient utilization of assets. Then other way, if the ratio is on the lower side, low, that is ideal underutilization of assets. Assets are not properly being utilized. Heavy capital investment, promoters or units contribution by way of capital is more. Then another ratio, that is gross profit ratio. The gross profit ratio, if it is high, and obviously it is good sign, but certain negative features can be drawn. One of these features, if it is high, that some manufacturing expenses are not accounted. As a banker, it is to be explored. We have to have thorough examination if at all any doubts arises. Okay. Then another feature is sales value taken instead of cost of sales. Here this working capital, while computing this one, sales value must have taken instead of cost of sales. Then if the ratio is on the lower side, what is the interpretation we can draw? That increase in the cost of production. Cost of production must have been increased if it is computed on the basis of cost of production or cost of sales. If cost of production is on the higher side than that of the required level or the normal level, then naturally the ratio will be on the lower side. Then selling raw material instead of finished goods. The company must have resorted to selling of the raw materials instead of finished goods. These are all the signs or interpretations can be arrived at or drawn when this ratio shows any variance up and down. Then operating profit ratio, it shows if the ratio is on the high side, is high, it's a higher turnover is more, it's a good sign. And second one is public utility service. The other service, public utility service, and naturally operating profit would be ratio would be on high side. And if it is on the lower side or low, the ratio is low, the stocks undervalued, and there is another possibility, low turnover. These are the major interpretations which are being drawn by a banker while going through these ratios. The proper interpretation of the financial indicators beyond mere ratio analysis helps in getting deeper insight into the affairs of a unit, which is vital for proper appraisal of the credit methods or credit needs. Now, it's another tool available for analysis of the financial statement is fund flow statement. Fund flow and cash flow statement. There are two types of statements, fund flow as well as cash flow. Normally we call it as fund flow and cash flow statement. Now, what is fund flow statement? What is cash flow statement? Fund flow statement is a useful tool in the financial manager's kit, analytical kit. The basic purpose of this statement is to indicate on a historical basis where the cash came from and where it was used. It is often regarded as a counterpart to the cash budget. The cash budget is the projection into the future, whereas the fund flow statement is historical. The fund flow statement contributes materially to the financial aspects which would answer to some questions, the following questions. That is, some questions in the sense, as a banker, the first question, which is why were the net current assets down when there is net income, when the net income is up or net income was up and vice versa. These things can be shown, which can be understood from while analyzing this fund flow statement. Another area is that how was it possible to distribute dividends in excess of the current earnings or in the presence of net loss? This is another question. how the unit can declare, unit can pay the dividend when it is making a loss. Then how was the expansion in the plant and equipment financed? This analyzing this statement, this information would be available. How was the retirement of debt accomplished? How was the increase in working capital finance? What happened to the proceeds of the sale of plant and machinery? What became the proceeds of the share issue and debenture issue? Where the money has gone? How it is utilized? These are the areas which are to be looked into at the time of analyzing the fund flow statement. Finally, where did the profit go? Profit, what they have earned, what they have made during the year, where did it go? The broad pattern outlining the movement of funds within an entity may be traced to successive balance sheets as illustrated below. Kindly have a look on the illustration. Here we are talking about XYZ, the company XYZ. The balance sheet and select financial indicators are given, that is 2012, 2013, what were the figures, what were the data. Well, first the capital. Capital comprises of equity and preference shares, that is maturity above 12 years. So that comes to this preference share capital 40 lakhs in the 2012, then 13, 2012, 40 lakhs. Ordinary capital, ordinary equity, that is 80 and 80. Both the years there is same data, same equity. The reserves and surplus 82,106. That shows there is an increase to the extent of 24 lakhs. There is a net change out of these 2 years position. This is the way the fund flow statement is being drawn. These 2 years there is a net accrual, net increase to the extent of 24 lakhs. Then long-term loans, that is a source of funds, long-term source. It is 113. It has gone down to 96. It indicates that the 17 lakhs, that is repayment has been made. Earlier it was 130. So by way of installment or otherwise, the outstanding has been reduced to the extent of 17 lakhs. Short-term loans, it was 47. It has gone down to 36. Yes, that also indicates it is reduced. It is a decline. It is a repayment to the extent of 11 lakhs. Then other liabilities and provisions, it was 39. Then it is increased to 46. Yes, this year also, 2013 also, they have provided more. So that is the reason why the provision has been increased to the extent of 7 lakhs. Now other liabilities, current liabilities and provisions, that is we have already said. Then total out of the 401, the first 2012, 401, that is a total source, and 2013 it is 412. What is the net position? We can work out. Then fixed asset, less depreciation. What is the net block? Fixed asset was 375 in the first year. It is increased to 412. That shows that it has been increased. There is a use, application of the fund. Then net block 208, there is plus. Then current asset. Another area is current asset. Current asset, it was 116 as on the 31st March 2012. That is increased to 171. That means current asset has been increased. It indicates that fund has been deployed for building up the current asset to the extent of 2 lakhs. Inventory, it was 90, and then again it is increased to 93. That means the inventory level, again fund has been deployed and has been applied to the extent of 3 lakhs. Sundry debtors 44 lakhs, that is increased to 63. That means debtors have been increased to the extent of 19 lakhs. Cash and marketable securities, it was 9, it is reduced to 1. That means 8 lakhs has been withdrawn or it has been utilized somewhere else. The loans and advances, that is asset, 26 it was reduced. That means we have received to the extent of 12 lakhs by way of loans and advances given earlier. So similarly, technical know-how. There was 24, it's continued, 2012 it was 24, it is continued in 24, and total 401, 2012 it is 401 is users and 404 in 2013. So there is a net position of 4. What inference? This is the position, because 2 years comparison we are making. Out of that, what inference we can draw, what interpretation we can make? The above statement reveals that there is an increase of 24 lakhs in reserves and surpluses and current liabilities and provisions to the extent of 7 lakhs. And this amount, that is 24 plus 7, there is an increase. This amount 31 lakhs is used to redeem the long term debt to the extent of 17 lakhs, to redeem for then second one for reduction of short term credit by 11 lakhs, and third point is for addition of net fixed asset by 1 lakh and current asset by 2 lakhs. Further, from the current asset, from the asset side, it would be found that the current assets have gone re-engineering, whereby there is a surplus of 2 lakhs has been registered. Then we can summarize this position. The position what we have drawn from the balance sheet or from the selected financial indicators, this position will come. Increase in the reserve and surpluses, because of that there is a source, that is to the extent of 24 lakhs. This comes 24 lakhs. Then increase in the current liabilities and provisions to the extent of 7. These two are sources. Then decrease in current asset, cash and current asset, the cash and marketable securities to the extent of 8 lakhs. It has come because a decrease. Then loans and advances, yes, money has come, repaid. So to the extent of 12. In all, the source, total amount received or raised from various sources is to the extent of 51 lakhs. As against that, where it is deployed, where it has been utilized, the increase in fixed asset, yes, we have seen 1 lakh. Increase in current asset, yes, we have seen 3 lakhs. And sundry debtors increased 19 lakhs. Decrease in long-term loans, that is repayment of the loans to the extent of 17 lakhs. Then decrease in short-term, long-term loans 17 lakhs, and decrease in short-term loans 11. The total funds from the various sources, the unit could raise 51 lakhs. That 51 lakhs has been utilized in various other liabilities. This will be squared off, that is 51 plus here also it is 51.